So we have our first speaker, Mr. Prabhat Ranjan, who is a CFA charter holder for CFA Institute, USA, BTech from BVP Pune, and MBA from Delhi School of Economics, and investment management professional with more than 5 years of experience in equity research, advisory, and portfolio management. He covers manufacturing, cement, chemicals, auto, and other sectors at Right Horizon. So on the second speaker we have is Mr. Vijay Chauhan, who has done his BTech from IIT and MBA from IIM. So he is an investment management professional who has previously raised capital with other partners based in Surat for investing in Indian small cap and micro cap companies. So he covers financial services, pharma, IT, FMCG, and other sectors at Right Horizon. So as a reminder, we request all participants to be on the listen only mode and turn off your webcams, and there will be an opportunity for you to post the questions after the presentation concludes. Please note that this webinar is being recorded. So I now hand this session to Mr. Prabhat Ranjan. Thank you, and over to you, sir.
Yeah, so thank you for the introduction, Prabhu, and a big thank you to all of you for joining us on this Saturday morning. So hope everyone is safe. And before we starting the presentation, just a quick disclaimer that our presentation and stock discussion is just for the audience awareness and educational purpose. And we are holding the stock in the portfolio, and please don't consider it as an investment advice, and do consult your financial advisor and do your own research before investing in the stock. So just to start with the agenda for today, Prabhu, if you can share the presentation here. Yes. So so today what we are going to do is first we are going to discuss. Can we please move to the next slide? So we are going to touch base upon the current scenario. Like we receive a lot of queries about the current market situation, right, and what should be the strategy for an investor to go forward. So we'll be discussing briefly on the current market scenario, and then we'll also deep dive into one of the paint sector companies that we have shortlisted for discussion today, case study today, and then we'll go through the financial metrics, investment thesis, some of the risk associated with the company, and in the end we'll have a strategy update of which this small cap company is a part of, right? So that will conclude with the strategy update, and then maybe in the end we can have question and answer round where we can take the queries of participants. So moving to the next slide, Prabhu. Yeah. So first of all, here at Right Horizons, we strongly believe that we should play to our strengths, right? So there are a few things that very difficult to forecast and predict and build a portfolio around that. And we generally feel that it's not a strong point to forecast those variables, right? So we constantly interact with our investors, our prospects, and we come to know that they are grappling with the same sort of questions, right? Will this bull market is going to end? If you're sitting on the cash, so is this the right time to invest in the market? Or they have made some profit in the market because the market has been very generous for last 1.5 years. So should we take out some profit from the market? Or will there be third wave coming, and that will take the market down with itself, or some sort of interest rate scenario that will not be favorable for the market, or there will be some sort of inflation situation that will come up and eat out on the earnings or the margin. It will become a impose a margin pressure situation for the companies. So these sort of things that constantly coming back and haunting the market sentiments, and again somebody who is new to the market or who has not done a deep dive on those sort of on the company's part. So mainly they try to find out the answer for these kind of questions, right? So absolutely we are with you that these are very difficult questions to answer, right? And even if we are right on one part that let's say the interest rate is not going to rise, right? Let's say we have forecasted that and the situation happens, but then this positive will be countered by another situation where the inflation will go up, right? And that will again will be a bad for the overall markets, right? So there are a lot of factors, and the probability that all of the factors will be able to forecast in a very clear manner, and that will come to a conclusion that will help us to construct a portfolio, it seems a very difficult one, right? So rather we take a step back and see how the overall equity market has done over the years, right? And what could be some of the ways we can take sort of we can go about to manage the volatility on the portfolio side. So if you can just move to the next slide, please. So we don't know these variables, but we know for sure that in last 30 years the equity market has been the best place, is one of the best places to invest, right? If you compare the 14.5% CAGR of the Sensex over like last 30 years with the nearest asset class, which comes cold, which has just given a 10% kind of return, right? But just a 4.5% outperformance over a period of 30 years leads to staggering wealth creation of 4x 5x than the other asset classes in comparison, right? Now that we know that equity is one of the certain asset classes where we can park our money and look for long term wealth creation, then comes the question of what should be the ideal period where for which we can target the equity market. So our next slide tries to answer the same question. If you can just move to the next slide, please. So if you look at the volatility, so the period of easy return in the market is over now, right? And if you have seen that the worries and the factors that have played havoc with the market have started to go up, and the market is reacting very decisively to those sort of factors, right? So if you look at we have done a study again over last 30 years, what should be the ideal period, what could be the win rate in the market, right? If you just go ahead and invest in something like market index. So what we have come to the conclusion that at least if we keep our investment safe over a period of 3 years, so at least there is a winning probability of 2/3, right? So 2/3 chances we will be end up making real returns. And by real returns, I mean that we'll be ending up beating inflation, which is 7%, right? So if you invest in the market, so there is a decent chance that 2/3 of the time that we'll be making more money then that can actually go up and add to our wealth creation over the longer period of time. So I'm not talking about making absolute return of 18 19 20% kind of, or even 14% kind of CAGR over longer period of time. I'm just saying that if we invest in the market for longer period of time, the chances that we'll make real return goes up drastically high, right? Now that we have made up the mind that okay, we are going to invest for a period of 3 to 5 years, but there could be intermittent volatility. So what should we go now? So our next slide tries to answer that question itself. So if you can just move. So what we have seen that whenever there is a setback in the market, next slide, please. So even take the example of last year when we have an unprecedented scenario, Black Swan event in terms of COVID, where the market was down around 31% from the peak, right? But it just took the base to form around 2 months, and then after that a year return. If you look at currently we are seeing, so the market is up 100% from that bottom, right? So this is the kind of return that one can expect if they are brave enough to buy the bottoms and the dips, right? But again, not all sort of companies are wealth creators in the long run, and not all sort of companies, if we keep on buying the dips, will add to the wealth, right? So there is a set of process that we need to follow. So there are some sort of companies which keep on making a new lifetime high, right? And even if there are some sort of, let's say, 15 20 25% kind of correction in those companies, so it's okay to buy the dips in those companies, because when these companies will rebound and make fresh lifetime high, so you'll end up making money. But then again, there are some sort of companies which have shady management, poor broken balance sheet and all. So these companies, if you keep on averaging, you will be destructing your wealth for the lifetime. So for that, we have a very strict process in house that we follow at Right Horizons, and these are the 4 pillars of investments that we will be discussing in next slide. So if you can move. So this 4 pillar of the investment process is mainly screener, score, risk manager, and pendulum, right? So this is the kind of process that we thoroughly imbibe at Right Horizons, and all of our portfolio companies that we take. So that comes from this set of 4 processes that we follow. So the first is the screener, then score, then risk manager, and the pendulum. So mainly we have done a study and which shows that the top 25% holding or top 30% of the holdings that comes from by following this process is actually it keeps on making the new lifetime high, right? So it's not like a case that you have invested at the high and then there will be a correction and then you keep on adding money and to average down the buys, but it doesn't rebound, right? So these sort of companies, these have good business fundamental, robust management guidance and all, and robust management practices as well. So these companies tend to make fresh lifetime highs on a very frequent basis. And that's what set them apart from the rest of the pack. The cyclical companies would be there, some turnaround stories would be there, right? So we can have a few of those, let's say around 15 to 20% the portfolio. There is no harm in betting those stories, but the majority and the core of the portfolio is defined by this investment process. So I'll just take a few minutes and I'll try to highlight what we try to do here in this framework. I have discussed this earlier also in one of the previous webinars, but just for some of the new participants. So the screener is a process where we take down a dump of 2,000 odd companies from the NSE exchange, and then we try to filter out the companies on terms of broad parameters like RO, like what would be the revenue growth for like last 3 years? Is it beating the 8% threshold that we have set? The profitability growth should be more than 8% again on a CAGR basis. Then ROCE, ROE of the company should be more than 12%, and then the debt equity level should be manageable and less than 1.5. The promoter pledging should be absolutely less than 25%. So those sort of screener filters that we apply, and then we come up with 100, 120 companies that fits the criteria out of 2,000 companies that we have initially shortlisted. Then what we try to do, we try to rank the companies in terms of the pecking order, right? So what we try to do, we try to identify 25 different parameters from 5 to 6 different verticals. We take some 3-4 items from the P&L, then 3-4 items from the balance sheet, some valuation metrics how the company is looking on EBITDA basis, how the company is looking on P to E basis, P by B basis, then what's the balance sheet number showing for the interest coverage ratio and all. Then we do some forensic checks and then try to assign some sort of rating on that, and then in the last we give our own analyst rating to those companies and try to see which of the companies out of this 110 or 20 companies that we have shortlisted arrive at the top, right? So mainly we do the ranking, and then of the top 20-30% of companies we do a deep dive into. So by deep diving means we do the financial modeling, we do a sensitivity analysis to identify the different the risk parameters which can impact the business going forward. So that way we come up with a portfolio of a stock. And this is necessarily the mid and small cap portfolio. So even though Bajaj Finance is a company which is which passes the filter, but we don't spend much time covering the companies because that's a already discovered stock. Rather than we try to focus our energy and our bandwidth to companies which are less discovered, right? So from here on, we get our set of companies we do a deep dive into, and then from the risk manager we try to mitigate the risk on the portfolio level. Then we try to mitigate the risk on a stock specific level by doing sensitivity analysis and all, and then we move to the final part, right? So it's very important to understand that buying a company is just one part, right? The second most important part is rebalancing it in a very timely manner, right? So I'll give an example, let's say a company, we set some threshold for both the buying and exiting the stock, and let's say a company meets our threshold criteria. Let's say we have set up a let's say a 2 or 3 year target of doubling the stock price, and if it meets the criteria, so what we do, we take out some profit from the pool and then try to keep it aside, right? So we know that market corrects itself over 3 to 5 months period, and we wait for that opportunity. So we are not in a hurry to redeploy whatever we have booked profit on, or whatever the additional cash that we receive from the investors. Rather, we try to deploy when the market sentiments are in our favor, right? And the stocks price, we set the guardrails, the stock price comes below the guardrails that we have set for entering into the stock price. So this is the another important part, that managing the portfolio that we have, right? We start with 20 or 15, 20 stocks, then we manage it very actively, keeping on all the cues and the stock price movement. And then the third and last important part is the exiting the portfolio. So I'll touch base upon those things towards the end of the presentation. But out of this investment process, we have come across some good mid and small cap names that we try to cover on our webinars, right? So building materials theme is one of the most themes we're quite bullish on, and we are playing the proxy theme through the housing material segment, right? So mainly we covered the PVC pipe business, Apollo Pipes, earlier under this theme. Then we also covered the wires and cable companies, Apollo, this Polycab, under the same theme, right? So today we have brought to you Sirca Paints, which is an emerging paints company, decorative paints company. So we'll try to do a case study on that company and try to explain it to you what the business does and what's the investment thesis behind holding the stock in the portfolio, and key risks, some of the risks associated with. So if we can just move to the next slide, please. Yes. So just to give a high level view, so paint segment is a well explored segment thanks to the companies like Asian Paints and Berger Paints, right? But let me tell you, just to start with this, that this is the fastest growing paint company which is expected to do a CAGR of 25% over next 5 to 7%, next 5 to 7 years. And also, on the valuation front, this company is the most attractive one, right? So just to give a high level view, the Sirca Paints got incorporated in the year 2006, and it's one of the top three premium wood coatings brand in India with a market cap of 1500 CR. And this company started importing PU products from Italy and Korea, and selling it through its distribution networks. So yeah, and the company has and raised up around 33 CR and set up its first manufacturing plant. So now currently a company has two manufacturing plants, one in the North India, the other in the South India. And the company sells its products to a 2000 plus strong distribution network that the company aims to take it to 5000 plus in coming few quarters, right? And company also focuses, it has identified opportunities to not just to grow in India, right, but also grow in the neighboring countries like Nepal, Bangladesh, Sri Lanka, and Middle East. So basis which it has devised a very strong strategy to market the premium Italian brands to those countries. In terms of total strength and team size, the company has around 400 employees, which are pushing the product through the dealer network. And companies also has acknowledged the retail power and the presence of it. So mainly the company has opened around 12 branches and 11 depots to push its products to more and more retail counters. So the company is headed by Mr. Sanjay Agarwal, who is the chairman and the managing director, and he has around 2 decades of experience in the paints and the wood coating business. And he is supported by his son, Mr. Apurva Agarwal, who is also heading the expansion plan for the Sirca Paints. So that was a brief intro on the company side. So if you can just move, I'll try to take you through the brief journey of the company. Right, it's just 15 years of the journey that the company has gone for. So the company incorporated as the Circular Wood Coatings Private Limited in the year 2006, and then 2008 it was the first one. Even just after getting incorporated, 2 years down the line, it was the first one to launch wood filler in India and open its wholly owned branches in Mumbai and Chennai. In the 2010, company did something which improved the efficiency of the company by shifting from manual tinning to the automatic tinning. In the year 2017, the company name was changed from Circular Wood Coatings Private Limited to Sirca Paints India Private Limited, just to resonate well with the parent stakeholder, right? In the 2018, the company filed for the IPO cause company has massive plans to grow the manufacturing and inbound activity. And in the 2019, set up a plant with a capex of 33 CR. It was the first plant to set up in Sonipat, and then in last year also the company has come up with an expansion plan. So it's setting up one more plant in Coimbatore with a capex of 5 CR, and then the company has entered into a manufacturing license agreement with Sirca SP Italy for manufacturing paints and thinners and sealers and all. So just there was a quick poll that our moderator has run, and actually we asked the participants where are we expecting market to move from current levels. So that was a mixed kind of bag. So around 40% of us expect that the market is is going to consolidate in the near bound region, right? So that's a very good sign. Even we are aligned with the same thing, that the market is expected, the good run for the market is over, and we can see some sort of consolidation in the market. And that actually brings us back to the presentation that we are doing today. That's very important to find out the bottoms of businesses which are very robust in their in the way they are coming up and announcing the growth plans, right? So it's very important to find a business which can sustain the growth over next 3 to 5 years, because a lot of companies are coming up, setting up the capacities that has done in the previous cycle as well. But the very few of the companies, handpicked of those companies, can actually come back and deliver on the same range, because there will be a lot of headwinds coming from the margin pressure side, coming from some other the interest rate hike and all. all. So those things will come and impact the business sentiment, right? But only the management which is very much focused on the business growth will be able to deliver, right? So that was the brief history that we just discussed. Just to move on and go through the brand portfolio of the company, what the company does. Yeah, so this is the core offering from the company. So mainly the company is into the wood coatings and wood coating side. So mainly they manufacture melamine and PU, right? So these are small plastic coatings that we apply on the wood furniture, right? So basically that coating is its kind of paint, but again it's very robust, very hard, and protects the furniture from the stains that comes on it, or from direct the damage to the furniture because of the sunlight or the moisture or something. So these are a very important segment that the furniture market caters to, right? So it's very important segment, the wood coating segment. So mainly it imports the premium brand Sirca, and repackage it and market it, and then it also manufactures in house at its Sonipat facility the PU product, which is most widely used in the market, right? And then it is also tied up with premium Italian brands like San Marco and the adhesive manufacturer Durante Vivan, right? So mainly it has gotten into exclusive tie-ups with those companies to bring the product to the Indian market and market it. So because of the excellent quality that Sirca offers, it has some marquee client lists in terms of Godrej, then Jindal Stainless, Indoline, Mass Furniture, Ars Cargo, and all. So these are some of the marquee brands. And if you look at the OEM list, right, currently it is a vendor to 300 plus corporates, right? So it is a preferred supplier, mainly because of the high quality of product that Sirca offers. So if you can just move to this next slide, we'd like to discuss about the business mix, right? So currently the 70% of the business comes from the retail side, and 30% of it comes from the OEM side. And on the OEM side, it is a well diversified base of 300 OEMs. So there is no client concentration there, and they are going to add more OEMs going forward. And mainly they have this luxury portfolio which they have tied up with exclusive partnership, right? So nobody has access to those exclusive portfolios in the market, so they can bring to their exclusive client set. And on the retail side, so they have just hired a key managerial personnel on the senior level who will be spearheading the expansion plans that my colleague Vijay will discuss later with you guys in detail, right? But just understand that currently they have, in the 3-year operation, they have managed to build a retail touch point of 2,000 plus. That's they are going to expand to 5,000 plus over next couple of quarters, right? So that's way that way. And again, they have this in-house studios and the branch depot that they are going to capitalize on. So they are equally focused on both the segments, right? And trying to derive the sales. So if you can just move to the next slide, please. Yeah, so this is how the brand is currently positioned, right? So the position of the brand is, it's important, it's good that they have the presence in the luxury segment, right, which is exclusive to it, right? And if you look at the luxury market, it's just 9 to 10 Indian cities, right? But if and they're already present in 6 to 7 of those cities. But again, if you look at the popular wood coatings brand, so it's widespread across the entire Indian. Across Indian market, right? So there is no as such preferred destination or preferred market for the product. So to tackle that challenge, they have come up with a Unico brand, and they are manufacturing exclusively. It's in the Sonipat facility. So that's a mass market wood coating product that they are mainly pitching to the economic or the entry level segment, right? So these are the melamine and PU products that they are pushing it to the clients. So in a nutshell, they have the all the categories of the wood furnishing products, and then they have recently ventured into the paint product itself, right? So they have all the varieties, 6-7 products, different products range to market it through a 5,000 strong dealer network or distribution network that will come online, right? So it's very important to have two set of things, right? So one is the distribution network, and then again you need to have the products, right? So that you so somebody is like coming to buy a decorative paint segment. So if you're just selling the entry level paint, so they will they will not buy. So if you have the entire range of product, so you can cross sell, and then you can also get the some sort of synergies as well there, right? So in that sense, that's the company is covered by coming up with 6-7 product launches, tying up with exclusively like major Italian brands like Durantens and Marco. So this the companies are doing. This the company is doing, and they are confident that once the dealer network will come, distribution network will come online. So all the other brands of the company will see some uptake in the coming quarters. So that was on the brand portfolio side. I'll just quickly also discuss the footprints of the company and the expansion plan. Prabhu, if you can just move to the next slide. Okay, so before that, if you look at the revenue metrics, how the company has currently the breakup looks like. So the revenue, if you look at, so the revenue has moved from 89 crore to 143 crore. It's a 17% capex CAGR revenue that the company has done, and it was expected to be around slightly higher side, but mainly because of the COVID, right? And then again there was one incident in one of the plants. The CAGR is looking slightly lower, but the company and the management looks very confident that they will be able to do a 25 to 30% CAGR growth over next 5 to 7 years. Also, the management has indicated that their long-term target is to do 1,000 crore of revenue that they can do. And if you look at the asset turnover, right? So they have set up a plant of 30 CR, which can generate a revenue of 240 CR, right? And then again they are coming up with a capex of 5 CR, which they can expect to fully operational and in coming few quarters, right? So those are some of the growth levers which are at play, right? And last quarter was one of the quarters in which the company has put a earnings breakout, right? And they have put that was a turnaround quarter for the company. So from here on we can see that just operating at a 25% utilization, the company has managed to come to this level. Now if that utilization level will go up to 100%, so there will be new growth areas that will be coming up in due course of time. So that was the mainly breakup that the company has. If you can just move to the next slide, Prabhu. So this is the broad footprint, right? So company has one plant in the North India and then one plant in the Coimbatore region that's coming up online, and then mainly because of all the dealer networks and the company set up over the years, and increasingly over the next few quarters, the company is going to set up 3 more plants, right? Just to cater the Western market, Southern market, and the Eastern market as well. And they are going to expand the dealer network, and they are going to make it 2.5x of the current one. So that will help us. That will help the company in achieving overall, 1,000 crore turnover target in due course of time. So that was mainly on the background of the company, what the company has done till now, what are the main brands, what some of the key important things that company has done over last few quarters, right? Coming back to the financial performance, the broad, the growth trajectory of the company, the investment thesis. So I'll now hand over this to my colleague Vijay, so he will be able to take you through all these things. So over to you, Vijay, now.
Yeah, thank you, Prabhat, for taking us through the journey and some of the product portfolio that Sirca hosts in the India. So now we have a solid background around the company that Sirca Paints is hovering around. So now we will dwell into the financial metrics, which will help us to connect the story of the Sirca Paints to the balance sheet. So we will begin with some of the broad level parameters, which are the part of the income statements and balance sheet. So what we have tried to capture in this snapshot, we have tried to capture the last 5 years revenue growth, operating profit growth, and also the profit growth. So there are a couple of interesting observations on the income statement side. So first thing we need to notice is that company has been able to grow its revenue each year. So a very important indication of consistent growth in the company's income statement, that company is doing new things, or let's say taking new initiatives, that is observable clearly in the revenue trend. Another important part that we can get from this side, that company is building the competitive advantage because it is able to generate and reinvest its profit to increase the revenue. Second interesting point, if we look at, is the margins. So if we exclude the FY20 margin, which is impacted due to the COVID, so we see the broad range somewhere around 23 to 25%. FY18 was a bit of a hype due to the inventory growth, but if we exclude that, we can see 23 to 25% of stable operating profit margin and EBITDA margin. So what this stable margin tells us, that this business is not a cyclical business. Okay, so if we look at the some cyclical business income statement, so we will see higher volatility in the operating profit margin. So these are a couple of like key triggers that we can see from any company's income statement when we are looking at revenue, or how are the margins across the 4 or 5 years of journey. And lastly, if we look at the profit growth, so profit has been also on the achieving the new highs every year, excluding the FY20, where the things went off in the Q4 and Q1 of FY22. So that is interesting highlight, or let's say interesting point that investor can derive from this, is that if profit for the company is hitting new highs every year, so eventually it will also get captured in the stock price. So we at RH strongly believe that stock price is just reflection of the underlying profit growth and the revenue of the company, nothing more than that. Okay, so and also if we look at on the leveraging side, so debt to equity is negligible for the company, and some of the parameters that we broadly look when we are like shortlisting the company, like net sales growth, return on capital employed, and leverage ratio. So we can see that it's comfortably matching our criteria of 8% for the net sales side. Our return on capital employed is around 14.4%, and debt to equity is also negligible for the company. So now moving on to the recent development. So this is a history or the last 5 year snapshot that how company is doing. Now we will look out the very recent update that company has gone through. So please Prabhu, move to the next slide. So this is a snapshot from the presentation of the Sirca Paints for the Q2. So if we look at the revenue growth, or let's say the EBITDA margin expansion, or EBITDA growth or profit after tax, there is been a huge jump for across the three metrics for the company. So it is clearly visible that the new plant that Sirca has started in 2020, because of the COVID situation, it couldn't make a major breakthrough for the company. But starting from Q2, the company has been able to start the manufacturing facility in a full-fledged manner, and they are also like able to pass it on to the balance sheet and some of the income statements parameter. So this is a very recent breakthrough that company has delivered in the fundamental side. So we are very confident that from here onwards we will see more upticks in the revenue. So this is a general story that we get from the looking at the any company's financials, that company is going through a growth phase. It has also a stable margin profile of EBITDA margin of 23 to 25%. So it's not a cyclical business. So now we know that company has some sort of moats or competitive advantages, but we need to dig deeper that what are the sources of that competitive advantages, so that we can like further strengthen our investment thesis. So please Prabhu, move to the next slide. Yeah. So in this slide, we have tried to capture some of the key competitive advantages, or some of the key investment thesis we think that these are working for the Sirca. Of course, due to the time constraint, we have like kept the very limited focus on the competitive advantage side and the major focus area. So first is the R&D. Sirca has tie-up with the Sirca Global, which is a Italy-based firm. So it has the world-class R&D team, which is like renowned across the global side as well. So Sirca has the best-in-class product access when it comes to the quality of the paints, which is comparable to the Asian Paints and ExxonMobil in India. Second part is the dealer network. So recently, like Sirca has hired the general manager of the Kansai Nerolac paints company, Mr. Narinder. So Mr. Narinder has over 30 years of experience in developing the dealer network for the Nerolac company. So he is trying to replicate the same process for the Sirca paints as well. And he has set very aggressive target from raising the dealer network from 2,000 or to 5,000 or in next 1 or 2 years mainly. So because he has been in touch with all those guys, so he's trying to replicate the same process, and we have seen strong results from the quarter 2 itself. Third point is the stable customer base. So if we look, the revenue is quite diversified, 30% to the OEM, 70% is the retail. So we don't see any major demand risk because we think that diversified revenue will help to deliver the stable profit and revenue growth. Fourth is a tie-up, or let's say the intangible assets in terms of the exclusive licensee, which Sirca has able to get able to manage from the global side. So it has exclusive tie-up with Sirca Global to market those products in the Nepal, Bangladesh, and Sri Lanka region for the 15 years. So what this offers us, this gives us the clear indication that for a 15 years, the Sirca will be able to grow its revenue very strongly. And it also gives the long visibility of the business, that company will have like stable growth, stable revenue numbers. So this is a very important part when we have something exclusive license or any intangible assets, which can protect our profit on the forward looking basis. Fifth one is the diverse and the large product portfolio that company is building very strongly through wood coatings, through wall paints, and also it is venturing into the southern market, which is a new for the company. So what this will help to Sirca is to give a one-stop solution for the manufacturers, because Sirca is already leader in the wood coating segment. So the same dealers will also market the products for the wall paints as well. So they don't have to build a new network for the wall paint, which they are trying from scratch. They already have a very strong dealer network through wood coatings, where they have a higher bargaining power because of the solid quality of the product. So they are going to use the same network for the wall paints as well. So we think that it will help us cross-selling benefit that Sirca is going to get from the existing relationships as well. And the last one is the stable relationship with the supplier, which is a source of sourcing risk. So basically, the raw materials for the paints and the wood coatings are mainly linked to the crude oil derivatives. Okay, so if there is fluctuation in the crude oil prices, or there is a not stable supply with the raw material, so there can be disruption in the material gross margins of the particular company. But as we have seen, like the resins or the colorants or the titanium dioxide, which are the major ingredients for the paints and the wood coating side, so they have a very strong relationship. So we think that it will help them to deliver stable gross margin, which is very important for any company to have stable gross margin, so that their operating expenses are also taken care. So these are like the 6 parameters or the 6 focus areas that gives us confidence that the Sirca will be able to generate the revenue of more than 25% CAGR for the next 5 to 6 years. Also, it will be able to achieve the outlook which has set in the current year FY22. So please move on to the next slide, Prabhu. So now we have idea like what Sirca is doing on the ground, on the factory level. So when we are building any B2C brand, which Sirca is also trying to do, so there comes 2 major factors in the B2C side when we are directly selling to the customers, or we are also selling to the OEM side. So we need to create a very solid brand. So the brand building efforts are mainly mainly done on the 2 levels. First is the advertising level, or let's say the marketing level or promotional level, which happens on the national level or regional level. Second is the on-ground marketing, which the company salesperson do, like by meeting the dealers, attracting them discounts. So Sirca has done the both of has done justice to both the parts. So if you look at the current marketing expenditure which Sirca is doing is around 4.5% of the revenue, so which is also at par and better than the industry participants. So if we look at the Sirca studios, so what they have done is basically they are displaying the product quality, and also they are giving the experience to the customers that how their furniture or how their walls will look like, which gives the clarity in terms of the client's mind as well. And recently, if we look at Sirca has also installed lots of billboards and the marketing campaigns in the north side of the country. So if we look at the Sirca has recently launched the 360 marketing campaign. So what it does is also advertises Sirca brand over the radio side. It is also planning to launch a new ad in the TV side, and also like it has converted those ads into the regional languages as well. So currently the company is working towards the southern market expansion. So we are hopeful that company will be also like converting those ads to the regional languages as pointed out by the management. Third point is the billboard side. So they have installed around 950 odd shop boards in the NCR region, so which gives a very solid visibility to the customers, and which forces the dealers to keep the higher stock of the Sirca, because the brand recall increases for the dealers as well and also for the consumers. And company is very strong on the R&D side. So company has launched this Sirca Parivar app on the innovation side. So where it is tying up with the contractors and dealers, where they are giving them the discounts and the rewards for selling the Sirca brand, which is they are trying to like automate the whole process. So current company is already onboarded around 8,000 contractors, which is a very solid relationship. We think that it will help Sirca to deliver the strong and stable profit growth and also the revenue growth. So these are the initiatives that company is doing on the marketing and promotional side, along with the capacity expansion unit. So moving on to the next slide, please. Yeah. So the efforts that Sirca is trying to put and build a future. So we have approximated the future, how the future company will look like in next to 4 or 5 years down the line. So first thing is the capacity that new plant has started to just operate. So we are expecting that it will be fully functional by this year end of March 22, which is the financial year. And the company will be able to achieve its 25% growth in the next 5 years each year. And the margins will be stabilizing somewhere around 20 to 23% going forward. So we think that the Sirca will be able to achieve at least 450 odd crore in the next 5 years by FY26. And if the future develops to our advantage and Sirca is able to do the better, they can also like cross the mark of 500 odd CR in next 4 to 5 years only. So this is the future outlook that we are thinking that Sirca will be able to present to its investor and also to their employees and clients as a whole. But also we need to look at the other side of the coin, which is also some of the antithesis points or some of the key risks that can derail the story of Sirca. So we have also tried to capture some of the key risks that we will also have a glimpse before we conclude. So Prabhu, please move on to the next one. Yeah. So we think the story of Sirca is robust, and it's already moving towards its direction of reaching the revenue growth and also on the EBITDA side. But we think there are some 4 major risks that as an investor we should be watchful. Also the company should be also watchful, as they have pointed in the earnings presentation and earnings call. So first is a COVID wave risk. Okay, so we think that we have recently we are passing through a new Omicron virus variant. So we think that if there is some disruption coming from the lockdown side or something, so it will also damage the demand growth, or let's say the demand from the consumer point of sight, so which will result in lower utilization, and also it will disrupt the supply chain. Also as we know, the majority of the wood coatings and paints, the raw materials directly linked to the crude oils. So it can happen that crude oil prices can be fluctuated. Although the Sirca paints and the other major companies also have the hedging contracts which protect them from the adverse movement. So it can also bring some inflationary pressure to the margin side, and also we can see some inflation coming out from the logistics cost and also the rise in labor cost. So we think that the company should be watchful of those couple of risks which can put pressure in the gross margin side and also on the EBITDA margin side. Third is the economic risk. So recently the Bank of England has started its first rate hike, because it's not now the economy has shown the clear signs of rebound. So we think that there will be some rate hikes going forward from the Central Bank of India, RBI as well. So it can lead to some liquidity slowdown in terms of the consumption of the consumers, but that will not like culminate into the long term demand risk. And the fourth one is the business risk, because Sirca has started the new plants, and so there can be some operational delays which happen in terms of the operational risk, or let's say the bottleneck issues which come on the plant execution side. So implementation executions are also important from the business point of view. So these are the like four risks that we will be watchful for the story of the Sirca. And also as an investor, like one can also look at the this major four risks when one is trying to analyze the business. So I think in due time we have like tried to analyze both the facets or both the sides of the particular business. But also like if if on an individual level, if someone wants to go and further deep dive into the thesis, because it's a never ending task, one can gather up endless amount of knowledge which is available in the annual reports or the earnings presentations, and one can always look for that. And with this, we will conclude on the our thesis on the Sirca side. Now I would like to hand over to Mr. Prabhat for our strategy update, where the Sirca is also part of the strategy. And over to you, Prabhat. Yeah.
Yes. So, like I have mentioned earlier also, so Sirca Paints is a part of our middle small cap portfolio super value. So that this is a strategy we restructured last year when we felt that next few years is going to be very favorable for the mid and small cap companies. So we did a one-time major restructuring, and now that in November of like last month, and the strategy has completed a year. And when we look at the performance, so the super value fund is up around 83% versus the mid cap index, which is up around 51%, and the alpha generated in last 1 year was around 32%, right, with respect to the index. And that has come with a very important criteria that we didn't take higher risk than the market, right? So the beta of the portfolio was somewhere around 0.81 or 0.82. So even with the lower volatility that we have, lower beta that we have managed to outperform the market. And this is the only strategy, super value, that has outperformed, or that has been the best strategy in overall categories twice in last 1 year, right? So in the month of February, the scheme was the best performing fund with 22% return, and in this month also, like last month end, it was up around 4.58% when the entire, like all the other indices were down, and it was the top performing fund. So the thesis remains same, right? So we only onboard ideas where we have the conviction that the earnings will double in next 3 years, right? So if you just break it down, that like 26% CAGR of earnings, it will double the portfolio earnings over next 3 years, and over the longer time frame, right? So 3 is a good time frame when the stock price return also converge with the market return, with the earnings growth, right? So that way we have constructed a portfolio. So, and again, we are equally vigilant on exiting the stocks, right? So let's say I'll give an example. So we onboarded one services based company, right, which is a monopoly company, right? We onboarded the company around 1.5 years back, and then like last month or last to last month itself, we completely exit the company with after making 6.5x return, because the company has already achieved the target of 1 lakh crore market cap, which we have thought it will achieve in 23, 24. That has already happened, right? So we don't fall in love with the stocks, and a very important part is that so now that we are going to move into a consolidation zone, right, where the market will give upside, but again it will be correct also itself with due course of time. So we are equally vigilant on taking away some of the profits, so that when the market correct itself, we can come back again and reinvest it, right? So this is what we have done. This is the summary of our last 1 year performance, right? And it has been a good track record that we have set for ourselves. So mainly what we target internally is to that onboard companies which can compound at a CAGR of 26% earnings growth, and the portfolio itself can double. Overall portfolio earnings can double over a period of 4 to 5 years, right? Portfolio earnings, and maybe the stock price can follow. And I'll just give an example. If you invest 1 CR, and if it compound at 18% for over next 10 years, right, it will be 5 CR, right, 10 years down the line. If it will compound at 24 or 25%, it will will be 10 CR at the end of the 10 years down the line, right? So that's the kind of compounding that we look for, right? Mainly benchmark return plus 3 to 10% kind of alpha over it, right? So those the overall ballpark figure that we targeted. And I guess, like, this is a very small, like, we don't have much time to cover in depth about everything that we do at the portfolio level. So if any of you wanted to understand more on the portfolio side, like, how we go about things, so please feel free to reach out to us, right? And we'll be more than happy to take you through each of the investment process that we follow, and, like, the kind of stories that we onboard, what's the thesis we try to follow, and what are some of the macro things that we are following on. So we'll be more than happy to take you through that. And with that, I would like to conclude the webinar today. So that would be all from our side, ladies and gentlemen. And maybe Prabhu, you can take it from here.
Yeah, okay. So thank you very much. And so we'll begin the question and answer session. Sir, so what we are witnessing across the companies now is so promoters' holdings are increasing across the companies. So I wanted to understand how will it be material for an investor, and then what is the promoter holding in the company for Sirca Paints?
Yeah, so Prabhu, yeah, so I think the question is quite valid from the audience side. So currently Sirca is around 67% odd holding coming out from the promoter, so which is a combination of the Indian family, Mr. Sanjay Agrawal and his family. It is around 47 odd percent, and remaining 18.18% with the Italy firm, and also there is a foreign body holding which is coming under the Sirca Italy, so which is around 3.5%. So Sirca has always been very vigilant on the capital dilution side. So as the internal capex is where internal profitability is quite strong for the company, so company is not in hurry to dilute the stake. Okay, they are not planning for any QIP, or they are not planning to do any further capacity expansion to the debt as well, because the internal flows are very solid, and also the capital they raised in 2018 through IPO around 33 crore, which is enough for the next 4 to 5 years of growth. So I think as an investor, we should be watchful that if the management should not dilute the holding on the consistent basis to drive the growth. So I think there is a very solid case for the Sirca, because it won't be required to dilute any further stake in the company side. Also, the free float is also very low, because promoter has around 67% of the company, and he is not looking to or they are not looking to do any dilution going forward as well. So I think it should work in the favor of the investors, and as well as also for the minority investors like us. So yeah, I think that answers the question.
Yeah, thank you, sir. Thank you. So the next question is from Mr. Surya. So he's interested in knowing what is the capex for the southern plant, and so how is Sirca Paints from a valuation perspective? How is it positioned?
Yeah, Prabhu. So if we compare the company's valuation with some of the industry leaders like Asian Paints or Berger Paints, so these companies are trading at currently 75x price to earnings multiple, right? In comparison to that multiple, if we compare the something like Sirca Paints, so that's currently trading at around 30x P. And if you look at the future growth guidance, right, the company is giving, so the future growth guidance is somewhere around 25 to 30% growth over next 5 to 7 year period. So on a PEG basis, like, the company looks much attractive compared to its peers, right? So that's how it is currently positioned.
Thank you, sir. So the next question is regarding so what are the new growth sectors, and any new play in EV?
Yeah, so I think that's a very concrete question regarding the future plays and future growth. Okay, so if we particularly we like the contract manufacturing in the FMCG side as well, like we have seen a solid renovation happening in the chemical side in terms of contract manufacturing, where lots of good companies like PI Industries and Aarti and SRF have been able to generate very solid shareholders wealth in last 1 decade. So similarly, we think that next opportunity is also for the FMCG side through contract manufacturing. Also, there is no clear leader in contract manufacturing for the FMCG. So we think that one sector can be this, that will have like a solid growth for next decade. Also on the EV side, so there are 2-3 different plays that we like. Okay, so we are not betting on any like a product side because we think that a global leader has a very solid product portfolio. So once the global player enters the domestic market, it will be unsustainable, or it will be very difficult because the competition will be very high for the existing participant. Instead, we are betting on one of the auto ancillary plays, which is also catering to the global leader in the electric vehicle side. So that is our favorable play. And another proxy way to play this thesis is through the battery side. So currently, if we look at the lithium ion batteries or electrolyte which is required for the lithium ion batteries, so there are only one or two leaders in lithium solutions, okay, in India. So one of them is Neogen Chemicals. So just to have a disclosure that this is also part of our portfolio, so it's not an investment recommendation, just for the knowledge purpose, that this company has a long track record of dealing with the lithium solution. And one can also look for the plays which are having a very disproportionate growth through the lithium ion solution. So one can also play the similar story of the electric vehicle through multiple fronts. Also, we at RH believe that to play anything, if we can get the business which is least risky, so that will also remain our preferred choice, given that it gives at least 8% more than kind of revenue growth, and also have some 12% return on capital. So I think that answers the query.
Yeah, right. So the next question is from Mr. Ramabhadran. So who is asking, what are the broad parameters you consider while investing in companies?
Yeah. So so thank you for the question. And on the top level filter, if we talk about, so like some of the key factors that one can look when investor is looking to shortlist the company. So first can be the revenue growth, because it clearly shows, like as we highlighted in the 5 years journey, that company should grow its revenue each year on the last year's basis. Okay, so it gives the comfort that the company has been able to capture the market share, or they are doing better, okay, in terms of the capturing the market share, and also they are taking new initiatives each year to push the revenue. Okay, that one thing is very important, revenue growth. Another important part one can look at is the return on capital employed. So basically, return on capital employed captures the percentage return that company is generating on their balance sheet. Okay, so let's say if we are investing 100 rupees in fixed deposit, so we will make 6 rupees on it. Just an example. So 6% is the return on investment or return on capital that one has invested. Similarly, when it comes to the business analysis, so we should look at how much company is generating in terms of percentage, whether it is generating 10% or 12% or 15% on the capital, because that will be the ultimately the stock growth. So if the company is generating continuously 15-20% kind of return on investment, so that they can reinvest those 20% in the business next year, and they can compound the wealth over few years by 20%. So these are the two major criteria when one is considering to invest. Also, the one thing also we can focus is the leverage ratios. The companies who are very leveraged will have like the higher volatility in the profitability. Okay, and that will also culminate into the stock price behavior, which is measured by the beta. So one should avoid it, because it can also like give you panic when the market, or let's say the cycle, is not in your favor. So we also looked at, and the last part can be the pledging side. It's just a broad level measure that the pledging should not be more than 25% or 30%, because in a panic time, or let's say when there is a bear market, so the players who have done the pledging will see the stock price pressure, because the borrower, or let's say the lending partner, will try to get the loan back through selling the stocks in the market. So these are the 4 basic parameters that one can look for. And other parameters when it comes to the investing has a long list, but these 4 parameters will give you a starting point and a good short list in terms of the 2000 listed companies in NSE. Yeah.
Sir, he has a follow-up question. So he wants to know what is the period of time to be remaining invested in before withdrawing in the PMS?
Pardon, Prabhu?
Okay, so he wants to know what's the time horizon before we can withdraw if we invest in the PMS? How long do we stay invested in the PMS?
Particular company? Okay, right. So at a PMS level, okay, so normally the holding periods are more than 3 years, okay, for every business that we look in. Okay, so like as Prabhat has pointed out in the strategy update, that our idea is to identify businesses which can double their earnings in 4 to 5 years, okay, with a minimum amount of risk. So that also is our holding period. So any business that we pick has more than 3 years of holding period. But what we have seen in couple of exits that we did recently, so the thesis has played out before even the 4 years or 5 years. Okay, so there was one service company which is a market leader in terms of the rail ticket. So we had that business picked up in 2019 time and beginning of the 2020 January. So what has happened? We had to plan this business to reach around 1 lakh crore market cap by 2024. But fortunately, because of the economy restrictions, like loosening out and also the supply chain side picking up, so there was lots of logistic movements and passenger movement started happening. So we saw the very solid stock price performance growth due to the strong business model and strong visibility, and the business crossed 1 lakh crore market cap in just October 2021 itself. So we ended up exiting that business. So we think that if the story has played out before our ideal investment period, so we will also exit those businesses because the valuation becomes very high and it becomes unsustainable for any share price. So our average holding period is around 3 years, but when it comes to the exiting the business, so we will make sure that the stock should not go in the overvalued zone as well. So that I think that gives you the broad idea.
And just adding to Vijay's point, so it's not just like how the company itself is doing, right? So maybe even after our exit, the company can continue to do well, right? It can compound at 15-20% growth rate. But at all point of time, you also do a relative analysis, how the other peer set or what's the opportunity cost in the company is in the portfolio is, right? So let's say the most of the return from a company, let's say the service-based company is front loaded, right? And even after the exit, it continues to compound at a rate of 15% or 10%, right? So the company is making money, but again, if we are finding some opportunity where we can compound our wealth at a rate of, let's say, at a faster pace, around 20%, 25 odd percent, so we'll make the switch, right? Because the return is front loaded and we have made our money, right? So we'll take the exit decision then and then try to find out the new ideas where we can have higher returns expectation. Yeah.
Sir, thank you, sir. So that was the last question. So due to time constraints, we would like to conclude the webinar. If you have any further questions, you may reach out to us through phone or email, and I will be glad to answer. So thank you on behalf of Right Horizons. Thank you for joining us, and you may now disconnect.